Canadian Mortgages, Part 2 Feet. Closed mortgage. The interest rate on a closed mortgage is usually lower than that on an open mortgage with a comparable term length. Your mortgage contract will usually include prepayment privileges, which vary from lender to lender. For example, one lender might let you make a lump sum payment equal to 20% of the original mortgage loan every year, while another might only let you pay down 10% every year. A lender might also allow you to increase the amount of your regular payments. If you want to change your mortgage agreement during the term, you will usually have to pay a prepayment charge to break your mortgage agreement. A closed mortgage may be a good choice if 1. The prepayment privileges provide enough flexibility for the prepayments you expect to make. 2. You are planning to stay in your home for the remainder of the term of your loan. Amortization period. The amortization period is the length of time it takes to pay off the mortgage in full. The amortization period is not the same as the mortgage term, which is the length of time your mortgage agreement will be in effect. If your down payment is less than 20% of the purchase price of your home, the longest amortization period allowed is 25 years. Although a longer amortization period means lower mortgage payments, it is to your advantage to choose the shortest amortization period, that is, the largest mortgage payments that you can comfortably afford. You will pay off your mortgage faster and will save thousands or even tens of thousands of dollars in interest in the long run. Mortgage term. The mortgage term is the length of time your mortgage agreement, including the interest rate, will be in effect. Terms can range from just a few months to 5 years or longer. Most borrowers require multiple terms to complete the amortization period and repay their mortgage loan in full. At the end of each term, you will need to renew or renegotiate your mortgage, unless you are able to pay it off fully at that time. If you pay off your mortgage or break your mortgage contract before the end of your term, you may have to pay a prepayment charge depending on the type of mortgage you have. Short-term mortgages. Short-term mortgages may be a good choice if 1. You plan to change your mortgage within the next couple of years, for example, if you expect to move to another city. 2. You expect interest rates to go down soon. Short-term mortgages are one of those Canadian mortgages that can help you avoid prepayment charges. A shorter term means you will not have to wait as long until your term's maturity date, when you can negotiate your mortgage or go to a different lender without triggering any prepayment charges. Long-term mortgage. Long-term mortgages help with budgeting, since you will know for certain what your housing costs will be for a longer period. Long-term mortgages may be a good choice if 1. You want to lock in a current low interest rate for a longer period. 2. You do not plan to make any changes to your mortgage for several years. Convertible terms. Some lenders also offer short-term convertible mortgages that can be extended to a longer term. When converted, the interest rate will also change to the rate offered by the lender for the longer term. Interest rates, fixed, variable or hybrid. When you apply for a mortgage, lenders may offer you options with either fixed or variable interest rates. Some lenders also offer a hybrid option that combines fixed and variable portions in the same mortgage. Fixed interest rate mortgages. You will know in advance the amount of interest you will have to pay, and therefore how much of the original loan amount will be paid off during the term. The interest rate is set or fixed when you apply for a mortgage. This interest rate remains the same for the entire term. The amount of your regular mortgage payments is also fixed. Variable interest rate mortgages. The interest rate can increase or decrease during the term. The interest rate varies with changes in market interest rates. How changes in the interest rate affect your payments will depend on whether your payments are fixed or adjustable. Fixed payments. You pay one set amount with each payment. If the interest rate goes down, more of the payment applies to the principal and you will pay off your mortgage faster. If the interest rate goes up, more of the payment applies to interest and less to the principal.